Welcome to the Lend Academy podcast, episode number 219. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register. Today on the show, I'm delighted to welcome Daniel Chu. He is the CEO and founder of the Tricolor Auto Group. Now, we're talking auto financing today and a specific niche within that, auto financing for the Hispanic market. So most of the customers that come to the dealerships of the Tricolor Auto Group, and they have dealerships in Texas and throughout Southern California, most of the people are thin file or no file, and yet they approve pretty much everybody who walks in the door, and we talk about how they're able to do that, the terms of the loans, and how the sort of the state of the auto finance market is for the Hispanic population. We also talk about securitization and how they've done many successful securitizations to date. We talk about how they're trying to graduate their customers into the traditional financial system. We talk about a new product they've got going and what their vision is for the future. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Daniel.
Thank you. Thank you, Peter.
So I like to get these things started by giving the listeners some background, and you have an interesting background in that you started off in basketball. Not many of my guests start off in sports. So why don't you give us a little bit of a rundown of the highlights of your background?
Sure. So oddly enough, I do have a background in sports, but really I think my experience in basketball really in many ways captured my interest and developed for me a passion in wanting to build something and maybe beyond that building something with really a clear purpose. Actually, as both a player and a coach, I was involved in 2 college basketball programs where the sport was reinstated after 10 or 12 years of inactivity. And so just being exposed to the process of starting something new where you had to mobilize all the different constituencies from players to fans to media to all the different support groups around a vision to create something that was going to hopefully be successful was really a great experience for me, and in many ways was maybe the best preparation for business possible. It really trained me to understand how to get alignment, to present a clear and compelling vision and get buy-in around that vision, very similar to the challenges really of an entrepreneur today.
Mm-hmm, mm-hmm. So it's interesting. It seems like you've kind of moved from basketball into the automotive space, and you spent, it seems like, most of your career there. So tell us a little bit about Tricolor and sort of the founding story. What was the idea that kind of led to it?
So I think at the beginning there was a recognition that the Hispanic market was highly underserved. And I think that opportunity led to really the notion that if we could figure out a way to address that segment, it was a differentiated enough segment where there truly was a purpose to providing a better product and a better service that could really be compelling. Mm-hmm. My parents were both immigrants, and in many respects, Asians and Hispanics share similar cultural values. There's definitely an importance around family. There's definitely a commitment to working hard to build a better future. And I think that gave me an appreciation for the Hispanic culture. As I spent time understanding that market, I think there were continued discoveries that led me to believe that there was really great potential in being able to serve that very, again, underserved segment. And one that I often think about is how intensely brand loyal that segment is. So to the extent you provide them with compelling value, I think you have a customer for life. And we've really built our business at Tricolor on providing for that customer superior value to anything that they really could find and access in the marketplace. And I think it served to help the company build really a sustainable business.
Okay, so why don't you just give the listeners a little bit of, a description of that business and sort of, how it operates, because I know you've sort of, you really are in the physical world, more possibly than the digital world. Maybe you can tell us a little bit about that, but sort of explain how the business operates.
Sure. So we do operate in a segment that's known as buy here, pay here within retail auto. So in the continuum of retail auto dealers, you have obviously franchise dealers and independent dealers. We operate in that subset of independent dealers, really the only subset within the entire continuum that has to finance the sale in order to actually transact it. That said, we look at our business on a much higher level. The real fundamental mission driving our business genuinely is a desire to enhance the quality of our customers' life. And we believe we achieve that by providing them with a vehicle of very high quality and with financing that's affordable and suitable to their specific needs.
Okay, so just maybe quickly, what percentage of people coming into your dealerships finance or need financing for their vehicle?
So over 99%
Wow.
of the sales that we transact are financed by us. And so clearly we're positioned in the market as a lender and as a retailer who can meet the specific needs of a consumer who really has a very, very low ceiling in the types of financial services they can access. They're really excluded from anything that would be considered mainstream, but at the same time, it's a segment of consumer that we've been able to observe as being not only appreciative of the opportunity to get financing, but works very hard to meet their obligation to the extent they're extended credit.
Mm-hmm. So then who are you let's maybe just step back and talk about the Hispanic market. If they're going out to buy a car today and they don't have the capital to do that, what are their options?
So generally their options would be with a dealer that would be operating in this buy here, pay here category. And really we would say we're the only operator serving that specific segment at scale. You will find, virtually in any of the geographies we operate in, the geographies we operate in, you will find operators that have had positive experiences and have been able to accommodate a Hispanic consumer that may or may not exist in the credit bureau. But we are really the only lender that's been able to address that segment at scale. Mm-hmm. And we believe we have a platform that leverages technology that enables us to do that better than anybody else with more affordable terms and really an opportunity beyond that to build credit and ultimately break through that ceiling that enables those customers to ultimately access traditional financing.
Right. So then maybe you could help us just give a little profile of your typical customer. And are these people, are they thin file or they have no file? Are they really, in the cash-based economy? Do they have bank accounts? Maybe just give us a little bit of a profile.
Sure. So the majority of our customers would fall into the category of being no file or thin file. And so either they have no bureau data or they have such limited bureau data that they become effectively unscorable. That said, the average borrower that we finance, even though they are thin file or no file, have resided in the United States for over 15 years. And that's really consistent with the research that we see in the market. There's a very good resource called the Pew Research Center. And Pew says that 60% of the undocumented immigrants in America have resided in America for in excess of 10 years. That's very congruent with what we're seeing in the marketplace. And so even though these customers that we're financing or these consumers do not necessarily exist in the bureau, they are established in the ecosystem in the U.S. and they have, in Texas, we average over 15 years in the U.S. In California, actually 18 years. In fact, a reasonably high percentage of our borrowers in California actually own their own business, even though they may be undocumented residents.
Mm-hmm. Interesting. So they have thin file and no file. I mean, how do you underwrite these people? I mean, obviously you're doing it's as a secured loan. You have the car as as the asset securing the loan, but you obviously don't want to have to go and repossess it. So tell us a little bit about how you go about underwriting when there is such little information formally on these people.
Sure. So our underwriting process both utilizes alternative data, bureau data, as well as what we would call application data. Even on no-file, thin-file consumers, there are a number of alternative data sources that we use that provide us with insights that we can utilize in the underwriting process. For those no-file, thin-file consumers, at the same time, we do rely on application data, which are data points that we are collecting from the customer face-to-face with them when they're in one of our retail dealerships. And we're collecting, Peter, probably 100 different data points from that customer in the application process. And what we've been able to do, and what has really been augmented very effectively with the use of artificial intelligence, is we've been able to identify patterns in both the application data we collect as well as the alternative data and bureau data that give us the ability to segment this consumer even though they may have no credit score that we can rely on.
Mm-hmm. Do they need to have a bank account to take out this loan?
So we don't require a bank account. It would surprise most people that about 80% of our borrowers do have a bank account. And so even though they are a no-file, thin-file, or in some cases undocumented, there are several banks, two major banks, Wells Fargo and Bank of America, that will provide that profile with a checking account. So the majority of our customers do have bank accounts, and actually we rely on an alternative data source called Decision Logic, which verifies that banking information. And that's an integral part of our process. For us, at the end of the day, with our underwriting model, we're measuring stability. And there is a correlation between a consumer that has been able to secure and maintain a checking account and their overall stability.
Mm-hmm. Mm-hmm. Sure. So then during the application process, this is happening face to face in one of your dealerships. Is this a paper-based experience, or is it digital, or is it some sort of combination?
So the information is gathered face to face. It is entered during that interaction with the customer. It is entered into an interface that we've built, which then feeds our credit decisioning engine. And so once all of that information is actually gathered, collected, and input, the process from there becomes purely digital. It's an automated underwriting process that's going to feed back to the dealership a grade, which and we grade in 6 different tiers, from A+, A, B, C, D, and the lowest tier, E. And so the process again, once we input that data into our, call it decisioning engine, is fully automated.
Okay, so then, and what percentage of the people pass the underwriting? What percentage do you turn away?
So there are a couple of conditions that would lead to an automatic disqualification, but for the most part, every customer that applies is going to be approved at some level. Mm-hmm. They're going to be graded somewhere on that continuum between an A+ and an E. What we're going to do is use that grade to drive the financing terms that we would offer the customer. So we're going to offer the highly stable, high-grade customers very attractive financing terms, low down payments, longer terms, lower installment payments, and conversely, we're going to offer the lower grade customers, we're going to require from those lower grade customers higher down payments. We're going to finance less over a shorter term.
Okay, so let's talk about the loans themselves. Give us a sense of the terms of these loans, the interest rates, the duration, that kind of thing.
Sure. I think it might be helpful to provide some context first.
Okay.
Within the buy here, pay here industry, when we look at the industry, we think about it being comprised of roughly 10,000 pure play operators, generally concentrated in Texas and the southeastern United States. If you looked at that segment overall, that group is originating loans with an average interest rate of between 22 and 26%, with LTVs of somewhere between 170 and 250%, at terms between 36 and probably 60 months. There are a couple of buy here, pay here firms that have been active in the capital markets, Drive Time being the most prominent, and they're originating loans to borrowers with FICO scores in the mid 500 range, and there have been two capital markets transactions from two other buy here, pay here firms in the southeastern United States with average FICO scores closer to 500. By contrast, what we've been able to do, really by applying and leveraging our risk model, is originate much lower LTV loans. So our LTVs average around 125%. And then we believe our financing terms are more affordable. So our average interest rates are around 16%, ranging from 9.9 to a very high grade borrower, up to about 19 or 20% for our lowest grade borrowers. And we're financing those customers over a term of between 48 and about 55 months. If you looked at how that translates into performance, I would say among all the buy here, pay here operators that currently enjoy capital markets access, our net credit losses are significantly lower, really going hand in hand with FICO scores. So to the extent our customer has a FICO score, it's probably averaging around 580. And so we're seeing net credit losses being incrementally or correspondingly lower across, our industry group.
Mm-hmm. Okay. So speaking of the capital markets, I know that you've sort of been active in securitization with, I think, was it the last deal that you did that was rated? And obviously, subprime auto hasn't got a great reputation in some ways it's been deserved. But just tell us a little bit about your approach to the capital markets.
Sure. So we probably would say first and foremost that our ability to access the capital markets is a pretty strong validation of our ability to actually segment risk with a borrower who, again, is a no file or thin file and so has very little bureau data that we can rely on. What we've been able to do, and we've done now 5 term securitizations, the last one was a rated one that Credit Suisse underwrote. What we've been able to do, I believe, is prove that not only can we fairly precisely segment this no-file, thin-file borrower, but we can fairly precisely predict their loan performance. And so as a result, I think through 5-term securitizations, we've always been comfortably under those loss assumptions. Mm-hmm. And we've seen continued success in terms of increasing the advance rates and the execution in those term deals.
Okay, so then I presume that you are submitting these payments to the credit bureaus, and so I imagine that this 580 FICO that your customers applied with, I presume, and maybe you can correct me, but I presume that continues to grow. Their FICO score keeps going up, and they're now becoming less of a thin file when they have a payment track record with you. So, I know you mentioned this earlier on. I mean, are you trying to move these people, like you said, into the mainstream, into mainstream finance, and maybe talk a little bit about how you're trying to do that?
Sure. So we absolutely are trying to graduate this customer. When we started our business and we made it very obvious that our intention was to ultimately provide a path for this consumer to access traditional financing, a lot of people were critical of that approach, saying that not engaging in the practice of really trying to build a repeat customer in our portfolio was ultimately going to impair our ability to grow. We actually believed in the contrary. We believed that to the extent we could provide a customer with affordable financing that allowed him to be successful and ultimately graduate to a lower cost of funds and more mainstream financing, we believe that would ultimately enable us to attract more and more customers, and I think that's been the case. So when a customer builds credit for us, and his friends and family see that he's been able to, on his next purchase, perhaps acquire a new pickup truck that is beyond anything he ever imagined he could access, purchase, and finance, we believe that business comes back to us really in a multiple, and I think that's been our observation.
Mm-hmm, mm-hmm. Sure. So I presume the vehicles that you're dealing with, I mean, these are all primarily used cars, I imagine. Maybe you could tell us a little bit about the average selling price and hence the average loan for these cars.
Sure. So our average sale price is right at $20,000, but most of the expensive vehicles we sell are large trucks and SUVs, which in Texas are by and large the preference of the customer we serve. Mm-hmm. But we're trying to sell across the board a much higher quality vehicle than what we're seeing overall, particularly in the buy here, pay here segment. We're selling a passenger car that is a 1 or 2 year old vehicle, and then a large truck or SUV that's maybe a 5 or 6 year old vehicle. But we're on the average or financing between $16,000 and $17,000, again, at an interest rate of approximately 16%, and on a loan term of around 54 to 55 months on the average.
Right. Okay. And so can you tell us, give us some sense of the scale? I think you mentioned Texas and California. I mean, how many locations do you have? What sort of volume are you guys doing?
Sure. So we currently operate 36 dealerships. 28 of them are in Texas, where we really started the business. We've been in California for 3 years now and operate 8 dealerships in Southern California. The California dealerships are a little larger scale than the Texas ones, simply because the magnitude of the market in Southern California is so vast and so enormous. We believe there's a tremendous market opportunity there, and so we try to serve that market with larger locations. But we currently are originating around 250 million loans a year, and we would anticipate growing about a little over 20% year over year. Mm-hmm. I think if you look at the last 6 or 7 years, we've grown at an average compounded annual growth rate of a little over 20%. And we anticipate most of our growth to be in California going forward. Our value proposition in California is very distinct. There aren't a lot of opportunities for our customer to secure financing that's affordable on a vehicle that's reliable, dependable, and sound. And so we really believe that our value proposition and the platform we've built that allows these customers to secure financing has become very compelling in that part of the country. Mm-hmm. We are opening in Las Vegas at the end of this year, and we will probably fill in gradually through the western part of the United States. Certainly, Arizona is a market that has some appeal, New Mexico, Colorado. And so as we continue to fill out in Southern California and potentially migrate through the Central Valley up to the northern part of the state, San Jose, Oakland, the Bay Area, we also will probably fill in between Texas and California into markets like Phoenix and Tucson and potentially Albuquerque and Denver.
Mm-hmm. Okay, so we're almost out of time, but a couple more things I really want to get to here. Firstly is you very recently launched an auto insurance product, which I just read about recently. So maybe you could tell us a little bit about that product and why branch out into something that, obviously it's quite a different product to a loan.
Sure. So in many respects, we saw auto insurance as it's marketed to our customers to be very similar to our observations in the buy here, pay here industry. We saw pricing that lacked transparency, that was inundated with high fees, and really did not provide the customer with the value that we believe they deserved. And so we did some research in the industry. We hired a couple of veterans of the agency business that served the segment of the population that resembled our consumer. And we really concluded that there was an opportunity to build an insurance business that relied on transparency in its pricing and that eliminated all of the brokerage origination fees that really made insurance so costly for our consumer. Mm-hmm. So we just actually launched this strategy this year in Texas. We're getting ready to roll it out across all the markets in Texas as well as California. And we really believe that it will be an opportunity again to leverage our platform, to leverage our customer base, our brand, a lot of the infrastructure we've built, and offer a service to the customer that has, again, really compelling value.
Mm-hmm. Mm-hmm. Okay, so then final question then, what about other lending products like beyond a car loan? Have you thought about, are you thinking about expanding into other areas?
So we have done our share of research into other products that we believe would allow us to offer a broader platform of services to our customers. We've looked at unsecured loan products. We've looked at really all the opportunities across the continuum. We really believe right now that our biggest opportunity is to continue to evolve our core business and then complement that with insurance, and that's really going to be our focus. But we have a bigger picture vision that I think ultimately as we scale will become much more efficient for us to leverage the existing infrastructure and add on to, and we certainly are optimistic that we'll be able to do that.
Mm-hmm. Okay, well, we'll have to leave it there. Daniel, good luck. I really appreciate you coming on the show today.
I appreciate the opportunity, Peter. Thank you.
Okay, see ya. I love hearing these stories of companies operating on the periphery of the traditional financial market and doing so in an honorable and a respectable way and helping their customers, not just getting a loan and being able to, to really provide them with a vehicle that could probably really help their livelihood considerably, but doing it in a way that actually helps them in the future, helps them graduate into more mainstream products. I think that is an honorable mission, and something that I think is going to really help bring expand this sort of the middle class of America. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register.